I'm Peter Reznicek from ShadowTrader.net, and this is the weekend edition. What a day, what a week. Slow grind down to sideways all week until Friday when we got the all-important unemployment data that pushed pre-market futures higher and essentially screamed soft landing. And it's currently this push-pull between less rate cuts and an economy that remains strong that is the current dominant narrative in the markets. And because this is so important to what's going on right now, sometimes we refer to this as the ruling reason. We're going to start on the fundamental take before we get into the technicals in today's show. If you recall, about a month and a half ago on this program, we were talking about potential of a recession, and that may still be on the horizon, but certainly the data that we got today quelled those fears a little bit, and the market kind of responded in kind. Let's take a look at this chart right here. Just as a reminder, this is the chart that I was showing you, like I said, about a month and a half ago, prior to the last two unemployment readings. You can see we saw this little uptick here coming up through the 4% mark and moving a little bit higher. And if you recall, the first time we started speaking about this, we were looking at a number of about 4.3. The next month ticked down at 4.2. And again, as we were saying, today's data dropped down to 4.1. Okay, so let's switch this over now to a more granular view so we can actually see the inside here of just the last few months, starting from like Feb 2024. This is the area we were talking about here of the uptick in unemployment since March, moving up. Here's where we started just talking about it around 4.3, and since then, instead of going higher, we've actually ticked a bit lower. You can see the next read came in at 4.2, and the next read came in at 4.1. So this is kind of noteworthy because I don't think we're completely out of the woods yet, but it's very important to understand what the ruling reason is and what the market is focusing on, basically. I feel that the market is very, very beholden to Fed action, and this has actually flipped things in a different direction in terms of what the Fed may be doing going forward, right? If we look at this chart right here, which is a close-up of the Fed funds futures rate, which actually shifted so much over the course of the last few days, it's amazing, especially since we got these good numbers today. Right here, this is the percentage chance of moving down at the November 7th meeting by only 25 basis, and this is the chance of moving down by a full 50 basis. Now, if you've been paying attention to what's been happening in the markets recently, as far as the Fed and how they feel about things and what their plan is going forward, you know that this percentage was much, much lower. It was actually much more skewed this way, where everybody was thinking they would get another half cut in November and then maybe a quarter towards the end of the year, right? But it's actually completely flipped. And if you look closely down here, it gives you the history, so to speak, of what this probability was recently in these columns. This is a 1 day, 1 week, and 1 month. And here's where it actually shows you, as I was saying, how there was so much more confidence in the market that we were going to get a 50 cut, and now we're only getting a quarter. You can see that a month ago, it was a 19.8% chance, right, that it would be a full half cut, and then we went to a 50% chance, then to a 32% chance, and now you can see the chance is less than 1%, and that's what gives you this big histogram here where it's 99.2% that we're only going to do a quarter, okay? And this is essentially where things get relatively tricky here, and it goes back to that concept of high confidence versus low confidence that I discussed in the video last week. In my opinion, the market for quite some time, I would say since about 2008, to be honest with you, those of you who have been trading for a long time, you probably see this phenomena developing over time. I feel like we now live in a post-fundamental society. And what I mean by that is that the actual fundamentals of what's going on with stocks, with earnings, matter so much less than Fed action, right? It's all about liquidity in the system, and that's all that really matters. And this is why things going forward are going to be a little bit tricky here, as I've been saying, because now we have this push-pull between the Fed is not going to be as aggressive as we thought cutting rates, and yet the economy seems strong. So all in all, it feels like we should be leaning neutral to bullish, basically, especially since we saw the action today, right? The action today on Friday, October 4th was extremely two-sided, which to me telegraphed very well and was a perfect sort of reflection of this dichotomy between these two forces in the market. But in the end of the day, you have to always go with who won out. And at the end of the day, what happened? The markets closed at the high of the day, right? After gap up, sell off, rally, tried to sell off again, and then rallied again up into the high of the day. So this tells you that more than likely the longer term players have the market under accumulation. The shorter term players are more just, selling those longs that they had from the futures overnight. It's the whole concept of old business versus new business, and you generally want to always position yourself where the new business is happening and don't get tied up or sucked in and faked out by the old business. Now that we've done a little bit of work together establishing the ruling reason in the market, which I believe is going to continue to be this push-pull between what is the Fed doing and the strong economy, let's take a look at the charts and see how things have been over the course of the week and where I believe that we are going. So there's a lot of dynamics in play here that I definitely want to talk about. Well, let's just start with the basics. Remember, I always like to keep my TA as simple as possible. Only 2 lines on the chart always, in addition to trend lines, which could be horizontal or diagonal, but really always 8 EMA, 21 EMA. That's it. If I'm trading intraday, I will add a VWAP, a volume weighted average price, on a 5-minute. That's what I call the 3-line method for day trading futures. But as far as longer term analysis is concerned, only 2. So we've got 8 EMA as the dotted green, 21 EMA as the more solid green, right? And you can see that from the cash market side of things, right, we actually spent the majority of the week in between those 2 lines. And that's basically like a no man's land and is kind of the worst place you can be if you want to enter trades. You're getting a lot of push-pull, you don't get any follow-through, and you're just not really moving. Now, today's action obviously changed the tone a bit, isn't it? We broke out from this small balance area and we moved up a bit. And if you connect these lines here, we just kind of peaked just above the downtrend line from the prior all-time high. So again, my take here is cautiously bullish with the understanding that the ruling reason out there is that this push-pull is probably going to continue a little bit. I'm not sure really just how emboldened these buyers are right now by the economic data. But again, we have to deal with what we have, and this is it. Now, very important, looking back over the market action since this rally. This is something that if you follow me on Twitter, and I've got my handle right there in the Chiron if you want to check me out on Twitter, I was mentioning that we have had an inordinate number of days in this market that have failed to close below the prior day's low. Even though those days have gone below the prior day's low, they have failed to close below the prior day's low, which is interesting. So if you look at all these days in question, starting from this swing low here about the first week in September, there were a number of days here where you actually took out the prior day's low, right? But then rallied right back into range, and that's relatively rare. So this market has really not taken that much of a break, even though there have been large liquidation breaks along the way. It's kind of noteworthy that we literally to this day, and from here I counted, it's exactly 20 sessions now, okay? In 20-day sessions, RTH, regular trading hour sessions, right? The futures in the ES have not closed, and in the cash market as well, in the S&P, we have not closed below the prior day's low in 20 sessions. And then what makes this relatively noteworthy is the fact that we are not one time framing higher, right? Remember, the concept of one time framing simply means when you are continually making higher lows and every day is a higher low, and as long as you're within 2 ticks of the prior day's low, that's considered one time frame, right? Like you can break the prior day by 2 ticks in the futures and you're still one time framing, or you stay above making that higher low, right? It's not like this market is making higher lows every single day because you have plenty of lower lows, right? Within here, as you can simply see on the chart, you've got plenty of new 2-day lows, right? And especially when we came down in here, which is really noteworthy, we were coming down closer to that 21 EMA. We continually had lower lows almost every day, and yet we would rally right back up into range. So kind of an interesting dynamic. Does it mean that there's a liquidation break coming? I don't know. But at some point, if you're bearish, and I wouldn't really be bearish here, but keep this in mind that the market at some point will take out the prior day's low and it will hold and go a little bit lower, just by the law of averages, right? It just has to happen at some point. It's very odd that the market is not holding a 2-day low up until this point. So keep that in mind. But overall, as I was saying, generally bullish, especially given the pattern. Anything can happen, but the market does seem to be focusing more on the strength of the economy and the fact that rate cuts are still coming, even though those rate cuts are potentially not going to be as aggressive as the market had hoped. And finishing up our TA today with the NASDAQ 100, as always, the other important market I like to talk about. Just pointing out it's still lagging. It's still well away from the all-time high, but however, the same dynamic that we saw in the S&P with a little bit of a trend line break here is happening. I think we're coming here to the dominant downtrend, so keep that in mind. It's about 20,100-ish as we come over there, so keep that in mind. About somewhere just over the 20,000 mark is probably where we're headed in the NDX. I do think it's pretty bullish that this entire down candle has been taken away, and that also happened in the S&P, obviously, but that's generally bullish, right? When you have a lot of emotional expansion of range on the downside like that, and then you come back to that area, I'm always a big believer that not all shorts have covered. There's probably more shorts that still need to cover, and then there'll be potentially some new longs initiating new business and maybe a little bit higher. So keep that in mind as well. Cautiously bullish, just like the S&P, same deal on the NDX currently. I'd like to take a short detour, if I could, right now in the program to bring your attention to something and someone that is very important to me. This is Mr. James Dalton, who is basically like a thought leader in the space of market profile. He wrote a seminal book called Mind Over Markets some time ago, which is really like the go-to book for everybody on this subject. And he continues to teach market profile as well. And he is now coming into the last intensive that he is ever going to do. I know we've said before a few times that maybe this is the last one, but I do think this is actually the last one that Jim is going to do. So I just wanted to put some attention on it here if you're interested. Jim is going to be teaching this one last time. These intensives are really an opportunity for people to go deep on the market profile. Basically, the way it works is he just teaches online for a month straight. And within that month, obviously, you get to see how Jim is looking at the market through the lens of market profile in real time as the market is unfolding. Now, a little bit of a caveat here. This is very, very important. It's not really a caveat. It's actually really a value add to me, is the fact that you have to understand that the way that Jim presents this material, it's not like what I do in my weekly ops advisory, for instance, where I basically not only teach you to fish, but I also just kind of give you the fish, right? Because I put out trades in real time and all you have to do is follow verbatim, and I have a really good track record, almost always at the high water mark of profits every single month. So you can just sign up there and just get the fish. I do want to tell you this is something different, and it is even more worth it in that vein. Jim will not ever give you any fish. He is basically not only teaching you how to fish, but more importantly, teaching you about understanding the environment properly, understanding market structure so that you can fish properly, right? It's not really about coming to the stream or the lake and having the right equipment and you know, everything set and everything. It's more about the fact that he's going to be teaching you what days you should be fishing and what days you shouldn't be fishing and what you should be looking for that's going to put the odds so much more in your favor. I tend to, you know, pride myself on that as well. Like I said, I do put out real-time trades all the time, but I spend about 2 to 3 hours every day on the mic with all of my subscribers, and a lot of what we talk about is basically this stuff here, is market structure and what is the environment telling us right now so that we can know how to act appropriately. Because remember, it's really all about what you don't do in the markets. I've said this many times, and it is so true. Your success is not going to lie in your winning trades ever. Your success is going to come from avoidance of losing trades, or modifying those losing trades, making adjustments, and cutting those losers down as small as possible, all right? So in that vein, all of this stuff is super duper important. I think it's very, very worth it. And I just wanted to give Jim a little bit of a plug because he is a dear friend of mine and he has taught me so much about the markets, and I'm very thankful for that. And to that end, this is gonna be the last time that Jim is going to be teaching a full-on month's intensive. It's actually October 16th to November 15th. I've put the link in the description of the video below, so if you'd like, you can join Jim there. Time now for our number one draft pick, which this week is Home Depot. Should benefit, right? I mean, if the economy is strong, as the numbers told us today, rate cuts are on the table as well, which should help the housing market. The stock has actually already been telegraphing this for a while, and I think that it remains strong. So let's take a look at the chart here if we could for a moment. This is daily chart of HD. I have started to dip a toe in this myself in the vein of short puts. ShadowTrader shorted some puts on the name today. There's a couple of good areas here that you can look at for selling puts, namely probably under today's low because it's a big reversal bar. You also have a 21 EMA at 393 here, and there is a prior breakout level here at about 380, which is also interesting. So however you want to slice it, if it's going to be short puts, long calls, the stock is basically looking good for a little bit more follow through. If the market remains sort of choppy and slow and grindy to the upside, you may want to favor the naked put or put vertical or some sort of a short put structure rather than laying out that debit on the call side. But overall, basically, I think that HD is going to continue a bit higher and the chart looks good. It's also one of the best relative strength names out there. Remember, I always like to start my analysis analysis from the charts, and that's really where it begins and ends with me. Everything that's happening is really just a tailwind in terms of these catalysts that we're talking about potentially having economy helping and lower rates, etc. That's all well and good, but it really all shows and proves here in the chart. And this is a chart that is obviously much stronger than a lot of the charts that we're looking at right now, right? You want to be kind of looking at charts like this that have new all-time highs and have much cleaner pattern than the market here. You can see how this is just kind of clean to the upside without too much chop, right? While the market is chopping, the stock is moving clean to the upside. So those are the charts essentially that you want to be short those puts in, potentially maybe even using that premium to buy calls, and basically just having a bullish outlook on names like HD. And that's my show for today. I truly hope that I have conveyed exactly what is going on in this market specifically and what is potentially to come. I do think there is a little bit of potential for continued push-pull. I'm not 100% certain how much this narrative of the stronger economy is going to help the market as much as the potential less rate cuts than it was expecting may hurt the market. So that's the push-pull. But as always, we have to go with the price action. And certainly the price action today on Friday, October 4th, spoke loudly and clearly that the market wanted to push away from that balance area to the upside rather to the downside. And it did construe the unemployment data ticking down. And also don't forget that non-farm payrolls as well, which just pushed up to what, like 257,000 as opposed to a prior period that I think was revised to about 159,000, right? So big jumps there economically. Seems like the market is focusing more on that than on the less aggressiveness of the Fed being more and more dovish into the end of the year, although some cuts are still coming, all right? Remember to hit that like and subscribe button, also the little bell that'll notify you whenever ShadowTrader posts videos. And as always, coming at you from Los Angeles, California, I wish you good trading and good night.